Hello and welcome to our channel. The risk-reward ratio is a valuable analytical tool available to investors. Since no investment is genuinely risk-free, the risk-reward ratio helps calculate the potential outcomes of any investment deal, good or bad. In the investment world, the reward-to-risk ratio shows how much money an investor can get compared to what they have to risk. We will tell you more about the risk-reward ratio of investing in this video, so let's get started.
Did you know? El Salvador was the first and only country in the world to legalize cryptocurrency as an official means of payment. There is an increased chance of losing money when trading in high-risk markets, including commodities and Forex. These markets are very liquid and volatile, and external factors, including economic indicators. Other derivative financial instruments, such as futures, forwards, and options, are also risky investments, as are certain stocks and exchange-traded fund investments. Some trading strategies are also considered high risk compared to others. Short-term systems, such as scalping and day trading, aim to make small but frequent profits from price fluctuations in volatile markets by entering and exiting a position as quickly as possible. These strategies can pay off if successful, but there is an equal risk of losing a large amount of money.
The Forex market is a good example when calculating the risk-reward ratio. When trading currency pairs, the slightest price movement is called a pip. And these pips move up and down when the value of a currency strengthens or weakens.
Let's say you open a spread betting position to trade on Euro-USD, which is probably the most popular currency pair to trade. You determine whether the currency pair will rise or fall in value. Suppose you set a profit target of 100 pips and risk 50 pips. That equals a risk-profit ratio of 1 to 2. This is because for every 50 pips you risk, you stand a chance of making twice as much profit. Remember, however, that you will need to factor in expenses, such as spreads and transaction costs, so that these profits will be slightly reduced. Economic strength and stability, as well as instability, can affect the price of a currency pair. In times of financial hardship, a country's national currency can collapse and weaken against the secondary or quoted currency of the currency pair. At this time, traders should be extra cautious when trading in the currency market, as currencies can depreciate at a very rapid rate.
The stock market is one of the most popular and liquid financial markets to trade after Forex. For this reason, it comes with many risks and rewards. The stock market consists of small, medium, and large cap stocks and blue chip stocks that set the benchmark for your industry. Different types of stocks provide different ratios of risk to return.
Like Forex trading, the stock market is equally affected by fundamental factors. Economic indicators such as press releases, earning reports, and the financial stability of a country can cause a company's stock price to fall. Alternatively, a company's stock price may soar after a positive earning report. This leads to a short squeeze where all traders immediately seek to buy the company's stock, causing short sellers to exit their trades as quickly as possible. This can be just as damaging to investors as a drop in the stock price. Trading stocks can lead to volatile results, so it is essential to emphasize the importance of risk management when entering a market with which you are unfamiliar. You should carefully consider the risk or reward ratio before making a bet.
As a general rule, the more money a person invests in high-risk stock, for example, the more significant the reward will be if the investment turns out to be profitable. Conversely, the less risky you are when investing, the lower the premium from the investment. In addition, the asset itself, the investment, directly affects the risk-reward ratio. For example, if a person puts their money in a savings account at a bank, the risk of losing that money is much lower because bank deposits are insured and it is unlikely that the bank saver will lose any money as a result of the transaction.
The investment fee for holding cash in a bank savings account is also low. Bank savings accounts usually offer low interest rates on insured bank deposits, which means that a person will receive little interest on the promise. Compare this scenario to a stock market investor who has no guarantee that the money he invests in a stock deal will remain intact in the future. It is even possible that the stock market investor will lose his entire investment amount if the stock goes bad and loses significant value. Accordingly, that investor probably expects to be more rewarded for their risk in buying the stock. If the stock rises in value, the investor is awarded for the trouble he took with the investment, because he is likely to make significantly more money on the stock transaction than a bank depositor would make on the interest earned on his bank deposit.
The formula for the profit-to-risk ratio is simple and is as follows. Divide the net profit by the value of the maximum risk of the investment, with a chance return ratio of 1:3. An investor risks $1 to make $3 in profits, with a risk return ratio of 1:4. An investor attempts $1 to make $4 potentially.
Suppose an investor weighs the purchase of a stock selling at $100 per share, and according to the consensus analyst forecast, the stock has a maximum price of $115 per share, with an expected bottom line of $95 per share. An investor makes a trade hoping the stock will rise to $115, but hedges his investment by placing a stop loss at $95, ensuring that his investment will not automatically be worse than the $95 sell-off. The investor can also lock in profits by instructing the broker to automatically sell the stock when it reaches its expected peak of $115 per share. In this scenario, the risk figure in the equation is $5, the total amount of money that could be lost if the stock falls and is automatically sold at $95. The reward figure is $15. This is the amount of money per share that an investor will earn when the stock price rises from buying the stock at $100 per share and selling it if and when the price rises to $115 per share. Thus, with expected risk of 5 and an expected reward of 15, the actual risk-to-reward ratio is 1:3, the potential to lose $5 to gain 15.
Investors have their comfort levels when evaluating risk-reward ratios in their portfolios. Some act cautiously, some take a moderate dose of investment risk, and others take more risk by actively investing regularly. The investment portfolios you create on your own or with the help of a money management professional reflect your risk tolerance.
There are 3 different types of investors. Conservative investors. These investors focus on low-risk, low-return investments, such as cash, bonds, bond funds, and large company stocks or equity funds. Moderate investors. These investors look for a combination of risk and return when building their investment portfolios, putting money into lower-risk investment instruments such as bonds, bond funds, and large company stocks and funds, with broader categories such as value and growth stocks and funds, international stocks and funds, and a small portion of alternative funds and investments, such as real estate, commodities, stock options, and futures. Aggressive investors. These type of investors may bypass conservative investments entirely and choose to fill their investment portfolio with higher risk stocks and funds, as well as higher risk assets such as gold and oil, stock options and futures, and even digital currency exchange. For example, a conservative investor may invest in corporate or municipal bonds, knowing that in exchange for guaranteed returns and asset protection, they take a small risk that the bond will default and the principal and interest on the bond will disappear. The aggressive investor understands that by investing in a high-risk stock, he is potentially risking some or all of his investment if the stock falls or does significantly worse. In exchange for the risk, the more aggressive investor can reap financial benefits in the form of skyrocketing stock prices and, as a result, significant returns on his investment.
Thank you a lot for watching this video. Stay tuned for more videos.